Hey everyone, welcome back to the channel. Today we're going to be diving into what's been going on in the markets, both crypto and traditional, because let's face it, it's been a brutal day. Bitcoin's down 5%, Ethereum's dropping harder than my New Year's resolutions, and even tech stocks like Nvidia are taking a nosedive. So what's the deal? Why is everything in the red today? So let's go ahead and break this down. First up, Bitcoin is trading at 96,900, shedding over 5% in the last 24 hours. It's not just Bitcoin though. Ethereum is down 8%, Solana has dropped more than 7%, and across the board we're seeing over 483 million in long position liquidations, and that's just in the past 24 hours. So what's caused all of this chaos? It's all about economic data, and it's painting a picture that could keep the Federal Reserve's rate cut schedule kind of keeping those hopes in check for the majority of people out there. Two major reports just dropped, and they've got investors recalculating their bets on what the Fed might do to loosen monetary policy even more. So let's go ahead and break this down. First, the Institute for Supply Management's December PMI report came in at 54.1, up from November's 52.1. Now, anything above 50 means that economic expansion is underway. So this was a surprisingly strong number. Translation, the economy might be holding up better than we were expecting, which isn't really what risk assets want to hear, because we want the Fed to start cutting interest rates and pumping our bags. Then we've got the JOLTS report. That's the job openings and labor turnover. So job openings were higher than expected, but hiring slowed down a bit. Oh, and the quit rate. So basically a measure of worker confidence. It dropped to 1.9%, down from October's 2.1%. So fewer people are quitting, and that means that workers are feeling less confident about finding something better. Not great for sentiment, really. Now, why does all this matter for markets? Well, stronger economic data means the Fed has less incentive to start cutting rates anytime soon. In fact, traders are now pricing in less than a 50% chance that rate cuts are going to happen before June, and at the upcoming January meeting, most expect the Fed to hold rates steady where they are right now. As for the stock market, it's taking this news about as well as I take a cold cup of coffee. The S&P 500 has fallen 1%, and the Nasdaq has dropped nearly 2%. Even Nvidia, which had all the hype going on with the CES, with the new AI initiatives, has tanked 6.2%. I mean, AI can do a lot, but apparently it can't stop people from being scared about rate hikes. So where does that leave us? Well, for crypto, this could be a signal that we're in for more short-term volatility. And if you just think about it, the Federal Reserve's monetary policy has been a major driver for risk assets over the past couple of years, and really all the way going back to like 2008, it's just been a straight rip up to the moon. And when rates are low, it's like pouring gasoline on the fire for speculative investments like Bitcoin, Ethereum, and even tech stocks. But when rates are high, or even in this case expected to be staying higher for longer, it's like turning off the fuel supply to the fire. So investors right now are in a bit of a holding pattern, waiting for a clear signal from the Fed. Will they pivot sooner than expected, or will this stronger than expected economic data force them to hold rates higher for longer, which they've been talking about, and they indicated in their most recent meeting that, they were planning, I believe it was 4 rate cuts in 2025, but now they've reduced it all the way down to 2. Now that doesn't mean that the rate cuts couldn't be bigger. Like I mentioned in the video yesterday, they could decide that what they're going to do is going to make 2 rate cuts, allow for more data to come in, but they're going to, they're essentially going to have a larger rate cut, but only 2 of them. That's still a possibility. So all of this uncertainty around rate cuts, this is essentially why we're seeing such sharp swings with over 483 million liquidated in just the past 24 hours. This tells us that there's still a lot of leverage within the system. And when the market shifts even slightly, it can create a cascading effect of market sell orders. So here's the thing. If rate cuts do get pushed further out, risk assets like Bitcoin, Ethereum could stay under pressure for longer. Remember, crypto has evolved into what's essentially a high beta asset. It moves like a tech stock on steroids. If the broader market is nervous about rate policy, crypto investors tend to follow suit. But it's not all doom and gloom. Long-term believers in Bitcoin and Ethereum argue that these moments of uncertainty are essentially where real opportunities lie in the market. If you zoom out, periods of high volatility often coincide with accumulation phases where savvy investors take advantage of lower prices. That's not to say that you should rush out blindly and load the boat. Always do your research, but these shakeouts can separate the weak hands from the strong ones. The bigger question, though, is whether we'll see a broader shift in sentiment if the Fed does signal rate cuts later this year. If that happens, crypto could see a significant rebound as investors flock back to riskier and higher growth type of assets. But in the meanwhile, don't be surprised if we see more day-to-day volatility. Every new economic report, whether it's the jobs data, inflation numbers, or GDP growth, it's going to essentially act as a mini stress test for the markets. And let's be honest, crypto is still very sensitive to macroeconomic trends. While many in the space will argue that Bitcoin is a hedge against inflation or a store of value, the reality is that most institutions, and especially institutional investors, they still view it as a part of their high-risk, high-growth portfolio. So if the broader economy stays strong, we might have to wait longer for the essentially second Fed pivot that many crypto bulls are hoping for. And by second Fed pivot, I just mean that they begin to loosen monetary policy even more than they already have. The takeaway here, buckle up, because this ride isn't over yet. Crypto markets are essentially at the mercy of macro forces right now, and until we get a clear direction from the Fed, expect more swings. The key is staying informed and sticking to your strategy, and avoid emotional decisions as much as possible, especially when things get bumpy. But let's go ahead and dive in here. Let's take a look at the chart and see what we can figure out. So right now we're going to do a quick look at the S&P 500, then we'll go into Bitcoin and then Ethereum as well. So looking at the S&P 500, and really, this is the benchmark for the market. It's going to give you a real idea of where we're headed. And what I really don't like is that, going back to August of last year, essentially the market moved up in this rising wedge pattern, and now we've fallen out of it. So, what we really want to see here is, because, this doesn't have to play out. I've seen rising wedges fail all the time. So that doesn't change the fact that I don't like it, what I'm saying. It could ultimately, if price does start pulling back, we're on the daily chart here, so we could pull back all the way to the 200 EMA. That's going to put the S&P 500 around the 5,600 mark. So, we could pull back to there, bounce, and then go higher, or we could just trend sideways. That's always a possibility. Right now, we've got essentially a reversal doji candle on the daily. We still have several hours before the market closes, but I would like to see if let me zoom in here. You can see this a little bit better. Ultimately, what we want to see, I would really like to see this close above the 55-day daily EMA. If it doesn't, then I want to see the next candle be a continuation pattern of this and push up above these EMAs, and then we start trending higher. I don't want to see this thing reverse and come back down, so we'll just have to keep an eye on that. If you look over at Bitcoin, it is doing a similar pattern to the S&P 500 now, and I'm not surprised, as these institutions start moving into the markets, we're going to see them become a little bit more correlated because, typically whenever investors start moving into the market, it's not just them moving into one asset. They typically move into several assets that they're looking to get into in their portfolio. So they might buy an ETF, or they might load up onto Bitcoin, Ethereum, etc. But what I don't like here is that Bitcoin... Now, I'm not a pattern trader. I trade algorithms that large institutions trade, and I trade based on Elliott wave theory and market geometry predominantly. But a pattern trader would look at this, and they might start seeing, and it's much clearer on Ethereum, is a head and shoulders pattern. So if you come up here, see this is a little shoulder, you got your head, come back down, and you put another shoulder. So if that does break, I wouldn't be surprised if Bitcoin were to come back down to the 80,000 level. Now, if it does do that, it's interesting because if you think about this from let me go to a little bit of a higher time frame here. If you think about this from a much larger view, a lot of people are thinking that we are going to be moving into the traditional 4-year cycle where, you have the 4 years, and then essentially around October, September of this year would be the top of the market. But what's interesting is that institutions are now here. So what that does is it adds a constant buy pressure to the market. So it's going to be interesting if we start seeing larger moves. So if we get a pull back to the 80,000 level, and then we start trending higher again, what we might see is this actually, it doesn't top in 2005. It's just that we might top in 2006. We might see that super cycle, extended cycle, just because there's so much money that is trying to flow into these assets. It can't flood in all at once, because if it did, the price would just be stupid. I mean, it would just, you can't force all that money into the market. It's like, you know, it's like, dropping a whale into a swimming pool. All the water would just flow over the sides. So, I mean, well, like I said, we could see an extended cycle and this thing move out into 2026. We're just going to have to keep watching the charts and seeing what it's doing. So take a look at here at Ethereum. Now, we're on the weekly time frame here, and it looks like it's just making a giant triangle at this point. It looks like we have this resistance here at the 3870 level, and we keep tagging it, but we also have this uptrending support creating this rising triangle pattern. So if we zoom into the daily time frame, we get a little bit more of a breakdown here. So in my previous Ethereum video where I did an update on the technical analysis, you noticed that I had this as a third wave, and I counted an ABC coming into the 50% retracement. And you'll notice that once that algorithm kicked in, you can see, move this over a little bit, you'll notice this candle right here. It skyrocketed up because those algorithms engaged, they started buying the price up. And so, these algorithms, they trade on both sides of the markets. All these institutions use them. So if you come down here from the high to the swing low, well, they took the opposite side of the trade. So they went right to the golden zone, and they started selling, and they have a target here at 2,900. Now, in my last video, I said I would be surprised if it broke this level, because a couple of reasons. One, because this is a fourth wave that I have it counted as, and the fourth wave typically retraces to, well, I guess that would count, because, you have this would be so the rule states that the fourth wave of one higher degree would typically retrace to the fourth wave of the lower degree. And so this would be the lower degree, and this is your higher degree fourth wave. So I guess if we do come down here, it's not terrible. It's still really close to that fourth wave target. But what we don't want to see is it go below 2770, because now you've got into the price territory of the first wave. And if it does that, the count's invalidated. That's a rule that you can't break with an Elliott wave, and so I'll have to just redo the count here. But what I really want to take away from this is that, look at the reaction, right? This is what we look for in the market. It went it went exactly to the 50, and if you know how to track these algorithms, you can see them just ping pong, right? So little ping, little pong right there, and now it's coming back down to support, where I have this blue line noting the where volume just drops clean off, and you'll notice that the candle is actually holding that very well. And you can see that in the price candles, how the majority of the candle body, not the wick, it's holding that price level here. And then as we come closer, you can see it again, holding. So, this is going to be a very critical level for it to hold, is the 3,300 level. If it breaks that support with volume, the next support you'd be looking at is 3,000, and then after that we'd be looking at the golden zone down at 2,900. So we'll just have to keep a look at that and see what's going on. I think that's the rundown for today. Let me know what you guys think in the comments. Do you think the Fed will hold rates steady for longer than we're all expecting, or is this just a bump in the road? And always don't forget to smash that like button and subscribe if you haven't already, and I'll catch you in the next one. Y'all stay safe out there.